Have you ever noticed how the entire market seems obsessed with gold whenever economic uncertainty appears? Every headline talks about gold breaking records. Every analyst discusses central bank buying. Every investor asks whether gold can climb even higher. But while everyone was watching gold, something remarkable happened in the silver market that many people completely overlooked. At the very same time, fresh economic data showing GDP growth near 1.5% has completely changed the conversation about what could happen next. That combination may become one of the most important signals precious metals investors have seen this year. For years, gold has dominated the spotlight whenever inflation fears or geopolitical tensions increase. It has earned that reputation over centuries because investors trust it as a store of value during uncertain times. Central banks continue adding gold to their reserves. Institutional investors hold gold as protection against financial shocks. Individual investors often buy physical gold whenever confidence in paper assets begins to weaken. Silver, however, often follows a very different path. It quietly builds momentum while the financial media focuses somewhere else. Then, almost without warning, silver begins outperforming gold. History has shown this pattern more than once. During several major precious metals, bull markets, gold usually makes the first move, while silver follows later with even larger percentage gains. This is exactly why experienced investors continue monitoring silver even when gold dominates the headlines. They understand that silver is not simply another precious metal. It occupies a unique position because it benefits from both investment demand and industrial demand. Very few assets enjoy that combination. Now consider what happened after the latest GDP figures attracted market attention. Economic growth around 1.5% tells investors that the economy may still be expanding, but at a much slower pace than many expected. This changes how markets begin thinking about inflation, interest rates, corporate earnings, consumer spending, and future Federal Reserve decisions. A slowing economy creates difficult choices for policymakers. If growth weakens too much, businesses may reduce hiring. Consumers may spend less. Manufacturing activity could slow further. Under those conditions, many investors begin asking whether the Federal Reserve can continue keeping interest rates elevated for an extended period. At the same time, inflation has not completely disappeared from the global economy. Prices remain well above levels seen only a few years ago. Housing costs continue affecting families. Insurance premiums remain elevated. Energy prices still experience periods of volatility. Food prices remain higher than many consumers expected. These conditions make the Federal Reserve balancing act even more challenging. Markets immediately begin looking ahead. Investors rarely focus only on today's data. They ask what today's numbers may mean 6 months from now. If GDP growth continues slowing, many traders begin expecting lower interest rates sometime in the future. Those expectations alone can influence precious metals before any official policy changes actually occur. Gold often responds positively whenever markets anticipate easier monetary policy. Lower interest rates reduce the opportunity cost of holding assets that do not generate income, but silver may react even more strongly because another force begins entering the picture. Industrial demand. A slowing economy does not automatically mean industrial demand collapses. Many long-term investment programs continue regardless of short-term GDP fluctuations. Governments continue funding infrastructure. Technology companies continue expanding artificial intelligence systems. Renewable energy projects continue adding solar capacity. Electric vehicle production continues growing across many regions. Every one of these industries consumes silver. Silver remains one of the most conductive metals on Earth. That property makes it extremely valuable for electrical systems, advanced electronics, semiconductors, solar panels, medical technology, telecommunications, and countless industrial applications. Engineers continue searching for alternatives, yet silver remains difficult to replace in many high-performance products. Now imagine investment demand increasing because investors expect easier monetary policy, while industrial demand remains supported by long-term technology expansion. Suddenly, silver begins benefiting from two powerful drivers at exactly the same time. This explains why some market professionals pay closer attention to the gold-silver ratio than gold prices alone. The ratio measures how many ounces of silver equal 1 ounce of gold. Historically, whenever that ratio becomes unusually high, many investors begin viewing silver as relatively undervalued compared with gold. Eventually, the ratio often begins narrowing as silver catches up. That process does not happen every year, and no timing method is perfect. But history has repeatedly demonstrated that silver can move very quickly once investor attention shifts toward the sector. The GDP report may become one of those turning points because it changes expectations rather than simply describing current conditions. Financial markets constantly reprice assets according to future possibilities. Investors ask whether slower growth increases recession risk. They ask whether inflation continues easing. They ask whether the Federal Reserve eventually changes direction. The US dollar also plays a central role in this story. Precious metals generally perform best whenever the dollar loses momentum because international buyers find gold and silver more affordable. If slower economic growth eventually places pressure on the dollar, precious metals could receive another layer of support. However, markets rarely move in straight lines. Strong employment reports or unexpected inflation surprises can temporarily strengthen the dollar even during periods of slower economic growth. This creates volatility that often confuses newer investors, while experienced market participants focus on broader, long-term trends. Another important factor involves Treasury yields. Rising bond yields usually compete with precious metals because investors receive income from government bonds, while gold and silver produce no yield. But if weaker economic growth eventually causes yields to decline, precious metals often become relatively more attractive. Silver may benefit disproportionately because it remains a much smaller market than gold. It requires significantly less investment capital to create noticeable price movements. Even moderate increases in investor demand sometimes produce surprisingly large percentage gains. Supply also deserves careful attention. Expanding silver production is not easy. Most silver comes as a byproduct of mining other industrial metals, including copper, lead, and zinc. That means silver supply cannot always respond quickly, even when prices rise sharply. Mining companies require years to develop new projects. Environmental approvals, financing, infrastructure construction, and labor availability all influence production timelines. This limited flexibility sometimes creates tighter supply conditions precisely when demand begins accelerating. Recycling contributes additional supply, but recovered silver cannot always satisfy rapidly growing industrial demand. Much of the silver used inside electronics, medical devices, and modern technology remains dispersed across millions of products rather than returning immediately to refiners. Institutional investors understand these structural realities. They analyze supply-demand balances years into the future rather than focusing only on quarterly price fluctuations. This longer perspective often explains why professional investors begin positioning themselves before major trends become obvious. Central banks provide another interesting signal. Although they primarily purchase gold instead of silver, their continued accumulation demonstrates ongoing concern about long-term currency diversification. Growing official demand for hard assets reinforces confidence throughout the broader precious metals sector. Geopolitical uncertainty also remains impossible to ignore. International conflicts, trade negotiations, supply chain disruptions, and regional instability continue influencing investor psychology. Whenever uncertainty increases, safe haven demand frequently supports gold first before spreading toward silver as confidence in the sector expands. The most important lesson from previous market cycles is that leadership often changes without warning. One month, gold captures every headline. The next month, silver quietly begins outperforming. By the time financial television starts discussing silver, much of the early move has already taken place. That possibility deserves attention today because slowing GDP, changing interest rate expectations, resilient industrial demand, constrained mine supply, and ongoing global uncertainty are all interacting simultaneously. Each factor alone might not produce a major rally. Together, they create conditions that serious investors cannot afford to ignore. The market appears focused on yesterday's story, while silver may already be preparing tomorrow's opportunity. In the next part, we will examine the specific economic scenarios that could allow silver to outperform gold, and why many professional investors believe the next phase of the precious metals market may look very different from the one most people expect. One of the biggest mistakes investors make is assuming that gold and silver always move together at the same speed. While both metals often rise during periods of economic uncertainty, the size and timing of their moves can be dramatically different. Gold usually attracts the first wave of defensive money because it has a longer history as a global reserve asset. Silver often waits quietly before suddenly accelerating once confidence spreads across the precious metals market. This pattern has appeared repeatedly throughout history. Gold begins attracting attention as investors seek safety. Financial news focuses almost entirely on gold prices. Then, as confidence grows, investors start looking for assets that may offer greater upside potential. That is often when silver begins outperforming. The latest GDP figure, around 1.5%, has added another important piece to this puzzle. Slower economic growth does not automatically mean a recession has arrived, but it does increase pressure on policymakers to support future growth. Investors immediately begin asking whether the Federal Reserve will eventually reduce interest rates if economic activity continues cooling. Markets are always looking ahead. They rarely wait for official announcements before adjusting prices. If investors believe rate cuts are becoming more likely, they often begin repositioning their portfolios months in advance. Precious metals have historically benefited whenever expectations shift toward easier monetary policy. Real interest rates remain especially important. These represent interest rates after accounting for inflation. If inflation remains elevated while nominal interest rates begin moving lower, real yields decline. Lower real yields generally improve the investment case for gold and silver because holding non-yielding assets becomes relatively more attractive. The US dollar also deserves close attention. The dollar remains one of the strongest influences on precious metals because gold and silver are priced globally in dollars. A weaker dollar often increases international demand as buyers outside the United States gain additional purchasing power. However, this relationship is not always perfect. During periods of global financial stress, investors sometimes buy both the dollar and precious metals simultaneously because they view both as defensive assets. Understanding why the market is moving often matters more than simply observing that it moved. Another powerful force supporting silver comes from industrial consumption. The global transition toward cleaner energy continues requiring enormous quantities of silver. Solar panel production remains one of the fastest-growing sources of industrial demand. Every expansion of renewable electricity requires additional silver because of its unmatched electrical conductivity. Artificial intelligence is creating another source of long-term demand that many investors still underestimate. Building advanced AI infrastructure requires massive data centers, sophisticated processors, high-speed networking equipment, and advanced cooling systems. Every layer of this technology ecosystem depends on electrical components where silver plays an important role. Electric vehicles continue adding another layer of demand. Modern automobiles contain significantly more electronic systems than previous generations. Battery management charging equipment, safety sensors, navigation systems, and advanced communication technologies all contribute to increasing silver consumption. Medical technology represents another growing market. Silver possesses natural antimicrobial properties, making it valuable in wound care, medical instruments, water purification, and specialized healthcare equipment. While these applications consume smaller quantities individually together, they contribute to steady structural demand. Supply, however, remains far less flexible. Most silver is produced as a byproduct during mining operations for copper, zinc, lead, and gold. This means silver production often depends more on the economics of those primary metals than on silver prices themselves. Even if silver prices climb rapidly, mining companies cannot instantly increase production. New mines require years of geological exploration, environmental approval, financing construction, and infrastructure development. This delayed response can tighten supply precisely when demand begins accelerating. Investors should also remember that above ground, silver inventories are not unlimited. Industrial users consume large quantities every year. Some of that silver is recycled, but much remains locked inside electronics vehicles, industrial equipment, and consumer products for long periods of time. When investment demand increases at the same time, industrial demand remains strong, the balance between supply and consumption can tighten surprisingly quickly. Commodity markets have repeatedly demonstrated how small shortages sometimes produce outsized price reactions. Institutional investors understand these dynamics well. Many large investment firms monitor inventory levels, mine production, manufacturing activity, and currency markets simultaneously. They rarely make decisions based on a single economic report. Instead, they evaluate how multiple trends interact with one another. The recent GDP reading has become important because it influences expectations across several areas at once. Slower growth may affect corporate profits, employment, consumer spending, Federal Reserve policy, Treasury yields, and currency markets. Every one of those variables eventually influences precious metals. Another development worth monitoring is government debt. Public borrowing continues reaching historically elevated levels across many advanced economies. Servicing that debt becomes increasingly expensive whenever interest rates remain high. This creates ongoing pressure for policymakers to balance fiscal stability with economic growth. If governments continue running large deficits while central banks gradually ease monetary policy, some investors may become increasingly concerned about long-term currency purchasing power. Precious metals have often attracted capital during similar environments because they cannot be created through monetary expansion. Central banks continue reinforcing this message through their own actions. While they primarily purchase gold rather than silver, their steady accumulation reflects continued interest in tangible reserve assets. This institutional demand supports confidence across the precious metals sector as a whole. Investor psychology also plays an enormous role. Markets rarely move because of one single event. Instead, momentum develops gradually. Early investors begin buying based on improving fundamentals. Prices rise modestly. More investors notice the move. Media coverage expands. Institutional participation increases. Eventually, retail investors enter the market. What started as a quiet trend becomes a widely recognized rally. Silver has followed this pattern before. It often spends long periods moving sideways while attention remains focused elsewhere. Then, when enough catalysts align, the price begins moving much faster than many expected. This does not guarantee another explosive rally is about to happen. Markets never offer guarantees. Unexpected inflation data, stronger employment reports, geopolitical developments, or shifts in Federal Reserve communication can quickly change investor expectations. Volatility remains part of every financial market. That is why successful investors avoid emotional decisions. They focus on evidence rather than excitement. They monitor long-term trends instead of reacting to every daily headline. They understand that building wealth often requires patience rather than constant trading. The current environment presents both opportunity and uncertainty. Slowing GDP, resilient industrial demand, ongoing technological expansion, government debt, inflation-concerned central bank activity, and shifting interest rate expectations are all interacting at the same time. Few periods offer such a complex combination of economic forces. Whether silver ultimately delivers another historic rally will depend on how these forces evolve over the coming months. But one thing is already becoming clear. The market story extends far beyond gold alone. Silver is quietly building its own case, and investors who recognize that early may be better prepared for whatever comes next. In the final part, we will bring all of these pieces together and discuss what disciplined investors should watch next and why the next major move in precious metals could arrive sooner than many people expect. As we bring everything together, the biggest takeaway is surprisingly simple. Most investors are still looking in the wrong direction. They are watching every move in gold while paying far less attention to the signals emerging in silver. That does not mean gold has lost its importance. Gold remains one of the strongest safe haven assets in the world. But history reminds us that silver often delivers the biggest surprises after gold has already attracted the spotlight. The recent GDP reading near 1.5% has forced investors to rethink the direction of the economy. Growth is slowing, but it has not completely stalled. Inflation has eased from its highest levels, but it has not disappeared. The labor market remains relatively resilient, but signs of cooling are becoming more visible. This creates an environment where uncertainty begins replacing confidence. Financial markets rarely like uncertainty. Investors start preparing for multiple outcomes instead of betting on one single scenario. Some expect the Federal Reserve to keep interest rates higher for longer. Others believe slower economic growth will eventually force policymakers to begin cutting rates. Every new inflation report, every employment report, and every Federal Reserve statement now carries greater importance than ever before. This uncertainty is exactly why precious metals continue attracting attention. Gold offers stability during periods of financial stress, while silver offers both defensive characteristics and industrial growth potential. That combination makes silver one of the most interesting assets in today's market. Industrial demand continues creating a strong foundation beneath silver prices. Solar power expansion remains one of the fastest growing industries in the world. Governments and private companies continue investing billions of dollars into renewable energy infrastructure. Every new solar installation requires silver. Artificial intelligence is creating another long-term opportunity. Every new generation of AI technology depends on powerful data centers, advanced processors, networking systems, and electrical infrastructure. These technologies require materials capable of delivering maximum performance, and silver remains one of the most valuable metals for these applications. Electric vehicles continue expanding across global markets. Modern transportation depends on advanced electronics battery systems, communication equipment, and charging technology. Silver plays an important role throughout this entire ecosystem. At the same time, mining supply remains relatively constrained. Bringing new production online takes years, not months. Environmental regulations, financing labor shortages, and rising operating costs continue limiting how quickly supply can respond. This creates a situation where demand may continue growing faster than available production. That imbalance does not guarantee dramatically higher prices tomorrow. Markets never move in perfectly predictable ways. Unexpected economic strength could support higher interest rates for longer. Inflation could cool faster than expected. Industrial demand could temporarily slow if global manufacturing weakens. These possibilities deserve equal attention because successful investing always requires balancing opportunity with risk. Another factor investors should continue monitoring is the US dollar. Currency markets influence precious metals almost every day. A stronger dollar often creates short-term pressure, while a weaker dollar frequently provides additional support. Watching the dollar index together with Treasury, yields, and inflation data offers valuable insight into the broader market environment. Central banks also remain an important part of the story. Their continued purchases of gold demonstrate that many countries still value tangible reserve assets during uncertain times. While they generally do not accumulate silver in the same quantities, their actions reinforce confidence in the precious metals sector as a whole. Market psychology may ultimately become the deciding factor. Every major rally begins quietly. Early investors notice improving fundamentals before the majority of the market recognizes what is happening. As prices gradually rise, confidence improves. More investors enter the market. Financial media increases coverage. Institutional capital begins flowing toward the sector. Momentum builds upon itself. Silver has repeatedly demonstrated that it can move much faster than many investors expect once momentum develops. That volatility creates opportunity, but it also requires patience, discipline, and proper risk management. The most successful investors rarely chase headlines. They study long-term trends. They monitor economic data. They evaluate changing market conditions. They understand that wealth is usually built through consistent, informed decisions rather than emotional reactions. Today's market presents a fascinating combination of forces. Slower GDP growth, changing interest rate expectations, resilient industrial demand, limited mining supply, geopolitical uncertainty, government debt, and evolving monetary policy are all influencing precious metals at the same time. Rarely do so many powerful drivers align in one market. Does this mean silver is guaranteed to outperform gold from here? No market offers guarantees. But it does mean silver deserves much more attention than it is currently receiving. Ignoring silver simply because gold dominates the headlines may cause investors to overlook one of the most compelling opportunities in the precious metals market. The coming months will likely bring more volatility. Inflation reports will continue shaping expectations. Federal Reserve meetings will remain closely watched. Economic growth data will influence investor confidence. The dollar index will continue moving markets. Every new piece of information will help shape the next chapter for both gold and silver. For long-term investors, the goal should not be predicting every short-term price swing. The goal should be understanding the larger economic picture. Those who remain informed, patient, and disciplined are often better prepared to benefit when major trends finally emerge. Silver has spent much of this cycle quietly building its foundation, while gold captured most of the attention. History suggests that this relationship can change quickly once investor sentiment begins shifting. Whether that moment arrives next month or next year remains uncertain, but the ingredients that have supported previous silver bull markets are becoming increasingly visible. This is why so many experienced investors continue watching silver with growing interest. They understand that the biggest opportunities often appear before the headlines catch up. If you enjoyed this analysis, make sure to like this video and subscribe to Silver and Gold Watch for more updates on gold-silver inflation, the Federal Reserve, and the global economy. Share your opinion in the comments because we want to hear from you. Do you believe silver is preparing to outperform gold, or do you think gold will continue leading the precious metals market? Thank you for watching, and we will see you in the next video.